Hello everyone, my name is Galita Putri and I'm going to discuss about Amazon's financial ratio. So, Amazon started as an online bookstore in 1994 and has grown into a global leader in e-commerce and cloud computing. The company thrives on innovation, customer focus, and long-term strategy. But behind the innovation and global reach, how is Amazon performing financially? In this presentation, we're going to explore Amazon's financial performance from 2020 to 2024 through key ratios to reveal its growth, challenge, and strategies. Let's start with working capital, which is the difference between current assets and current liabilities, reflecting Amazon liquidity. Its working capital rose from $6.3 billion in 2020 to $19.3 billion in 2021, driven by strong pandemic-era cash flow. In 2022, it dipped into negative territory due to rising costs and liabilities, but the company managed to recover in 2023 and 2024 by improving operational efficiency and cash flow. Amazon's current ratio remained close to 1 throughout the years, signifying that it had just enough current assets to cover its current liabilities. In 2020, strong online sales helped maintain its balance, but in 2022, high cost and expansion pressures made it harder to stay liquid. By 2023 and 2024, Amazon improved cost control and regained stability, showing careful management of resources without hauling too much into idle cash. Meanwhile, the AC test ratio shows how well Amazon could pay its short-term obligations using only its most liquid assets, such as cash and receivables. In 2020 and 2021, the ratio stayed stable thanks to strong cash flow. But in 2022, rising costs and fewer liquid assets caused the ratio to drop. In 2023 and 2024, Amazon managed to improve its cost management and cash position, helping the ratio to recover. The account receivable turnover ratio show how quickly Amazon collects payment from customers. In 2020 to 2021, the ratio was high because most sales were from individual customers who paid quickly. But from 2022 to 2024, the ratio dropped as Amazon expanded into B2B services, which led to slower collections and weaker cash conversion. The average collection period shows how many days it takes for Amazon to collect payments from customers. In 2020 to 2021, payments came in quickly thanks to strong e-commerce sales and short billing cycles. But in 2022, the period got longer as more revenue came from B2B services. The trend continued in 2023 and 2024 due to economic uncertainty, causing further delays in business customer payments. Inventory turnover shows how quickly Amazon sells and replaces its stock. Amazon's inventory turnover slowed from 2020 to 2022 as inventory levels rose with expansion. In 2023, there was a slight improvement as the company adjusted to match actual demand. However, in 2024, turnover declined again due to excess stock, weaker spending, and a broader product mix. Moving on to the average sales period, it tells how many days it takes for Amazon to sell its inventory. In 2020 to 2022, strong demand helped move products quickly, although by 2022, overstocking began slowing things down. In 2023, inventory efficiency improved slightly with cost cutting, but in 2024, the sale period reached its longest as Amazon dealt with excess inventory, a wider range of products, and cautious consumer spending. In terms of operating cycle, Amazon's operating cycle got longer from 2020 to 2024 because it took more time to sell inventory and collect payments. In the early years, products moved quickly and customers could pay quickly. But starting in 2022, the shift to B2B services, excess inventory, and slower client payments stretched the operating cycle. This means Amazon had to wait longer to get the cash back after spending it on inventory, which can put pressure on liquidity if it is not managed well. Now let's move on to the profitability ratios. Amazon's gross profit margin dropped in 2022 because of rising costs such as labor, shipping, and supply chain problems, which made it more expensive to deliver products. But starting in 2023, Amazon cut costs and earned more from high margin areas such as cloud services and advertising. These efforts helped boost profit margins again by 2024, showing stronger efficiency and a better balance between revenue and expenses. When it comes to net profit margin, Amazon's net profit margin reflects how efficiently it turns sales into profit. During 2020 to 2021, strong online sales and B2B growth drove steady profits. In 2022, profit margins dropped due to inflation, rising costs, and investment losses. However, by 2023 and 2024, Amazon improved its margin through cost cutting, operational efficiency, and higher revenue from profitable B2B segments. Next, asset turnover. Amazon's asset turnover shows how well it uses its asset to make sales. In 2020 to 2021, Amazon was able to earn high revenue from its existing assets, but from 2022 to 2024, the ratio went down as the company invested heavily in warehouses, delivery systems, and technology. These large investments caused assets to grow faster than revenue, making the assets use less efficient. When it comes to return on assets, Amazon's return on assets dropped from 2020 to 2022 because it made big investment in assets, while its net income also fell, especially in 2022 when it recorded a net loss. This made it less efficient in turning assets into profit. However, by 2023 and 2024, Amazon bounced back. Cost cutting, better margins, and stronger income helped improve how effectively it used its assets to generate profits. Meanwhile, Amazon's return on equity showed strong performance in 2020 to 2021 due to high net income and minimal equity dilution. In 2022, return on equity declined sharply because of a net loss from investment write-downs and rising costs. By 2023 and 2024, Amazon's improved profitability, driven by operational efficiency and growth in high-margin services, which led to a strong rebound in return on equity, signaling better returns on shareholder investment. From 2020 to 2021, Amazon's earnings per share remained steady due to strong net income driven by pandemic-fueled demand and stable share count. In 2022, however, earnings per share turned negative as the company reported a net loss, primarily from investment write-downs and rising costs. However, earnings per share rebounded in 2023 and 2024 thanks to improved profitability from cost reduction, operational efficiency, and growth in high-margin B2B segments. Next, Amazon's price-to-earnings ratio was high in 2020 and 2021, reflecting strong investor confidence and high earnings expectations. In 2022, however, the ratio dropped sharply due to a net loss, signaling a temporary decline in profitability. By 2023 and 2024, as earnings recovered and grew faster than the stock price, the PE ratio decreased, but also indicating a healthier and more stable valuation. Now we're going to move on to the solvency ratio. The first one is debt to equity ratio. Amazon's debt to equity ratio steadily declined from 2020 to 2024, showing a shift from debt-heavy financing towards a more equity-based funding. Initially, the company relied heavily on borrowing to fund aggressive expansion and pandemic-driven infrastructure needs. However, as profitability improved, Amazon's equity base grew, reducing its reliance on debt. This trend reduced financial risk and improved investor confidence. The next one is equity multiplier. Amazon's equity multiplier declined from 3.51 in 2020 to 2.36 in 2024, indicating that the company was relying less on debt and more on equity to finance its assets. During 2020 to 2022, high leverage was used to support rapid infrastructure growth, but from 2023 onwards, improved profitability and retained earnings allowed Amazon to grow equity, reducing its reliance on debt and strengthening financial stability. Moreover, Amazon's time interest earn ratio was strong in 2020 and 2021 due to high profits, but dropped sharply in 2022 as a result of rising costs and lower income. It rebounded in 2023 and surged in 2024, reflecting improved profitability and cost control. This recovery signals stronger financial health and lower solvency risk. The book value per share for Amazon increased significantly from 2020 to 2024. This growth was driven by rising shareholder equity from strong net income and limited share issuance. Even during 2022's net loss, equity remained resilient. The sharp rebound in 2023 and 2024 reflects Amazon's improved profitability, with retained earnings contributing directly to shareholder value. This trend signals solid long-term value for investors. Lastly, while dividend payout measures the percentage of net income distributed to shareholders as dividends, the dividend yield ratio shows how much a company pays in dividends relative to its stock price. In this case, Amazon prioritizes reinvestment over cash distribution, aiming for long-term growth over short-term shareholder payouts. Therefore, both the dividend payout and yield ratio were zero because the company does not pay dividends. Before the video ended, please check Amazon's consolidated statement of cash flows, consolidated statement of operations or income statement, and its consolidated balance sheet from 2022 to 2024. That's all for the videos. Thank you for your attention.